Now let's tackle some information related to notes receivable. Notes receivable is a more formal legal contract between the buyer and the company which requires specific payment amount at a predetermined future date. Again, so let's break it down. So it's a more formal legal contract between the buyer and the company which requires a specific payment amount. Well, it doesn't really, it's not really different from the accounts receivable, but it has a predetermined future date. Yeah, so uh, here it says that it has longer day than a year period. It's true that it can be longer than a year, but it can also be less than a year. It is an asset and it includes interest. Yeah, so probably the interest part is the part that differentiated from the accounts receivable. Notes receivable has certain characteristics, and you should know them and have a general understanding of them. First of all, it has the principal amount. The principal amount is the initial loan amount. Yeah, that doesn't include interest rate or interest at all. It is just that principal or first amount that the customer or gets from the buyer. Length of the contract, so it can be 6 months, 6 months. It can be 1 year or more. Interest is the part of the loan charged to the borrower, so it can be 10%, really high, but 3.5%, 7%, and so on. The issue date is the date on which the security agreement is initially established, so the date when the contract has been signed. And lastly, maturity date is the date at which the principal and the interest must be, paid. Here, let's take a look at some example. This example is quite long, so I'll take your time to read it to understand what it says, and then we will continue. Okay, I hope now that you have read it. Yeah, I hope you've paused and read it very carefully. So let's see the solution to it. Yeah. So what we have here is that on January 1, 2018, Underway purchased merchandise on the amount 250,000. The retailer agrees, BWW meaning retailer agreed to lend this 250 purchase cost or sales price to the waterways under the following conditions. They will sign a note payable that will be issued by the buyer. Buyer. The conditions of the note are that the principal amount is 250,000, the maturity date is 24 months, and the annual interest rate is 12%. So the very first entry that we will make is the recognition of that sale. Recognition of sale and note receivable. Again, we're doing this entry from the perspective of BWW. So this is BW or the retailer who is doing the retailer. Whose perspective we're looking at. So notes receivable is debited because they have now the asset. Don't forget, this is for the retailer, it is the asset. And the sales revenue because they have sold an item for $250,000. And then 12 months later, BWW recognized interest revenue, and they calculate the revenue of interest using this simple formula. Now, this last part is clearly, it doesn't really, you don't really need to write it down, but I wanted you to see that it could also be, so 12 in this case is months, number of months, so it could be less, it could be 6 months, for example. They could have recognized it on a monthly basis, so it would be recognized on a monthly basis. This 12 would turn out to be 1 month divided by 12. So in this case, they're recognizing after 1 year is over. So the entry will be interest receivable is now recognized because in fact now they have this asset earned and their receivable has to recognize as an asset of debit 30,000 and interest revenue because it has been earned by this point on the credit side. I hope this is very easy. You've done it before and it shouldn't be of an issue. So this is, so the first part was, wow, just a second, I'll erase this part because it's poorly visible. So we have sale and notes receivable recognition, and in this second case we recognize interest earned, not received yet, but not received. Ergo, we have the note interest receivable. Yeah, moving on to the date of the maturity. So date of maturity 2019, it's 24 months later. 24 months later, we record the remittance of cash. So the cash has been received. That's why we record 310. The 310 is 250,000 plus that interest for 2 years. Yeah, the first year was 30,000, and the second year also 30,000. In total, it is 310,000 of cash that has to be is owed by the customer and is eventually paid by the customer to the retailer. Therefore, we record it on the debit side. And on the credit side, we're going to record, so note receivable will be credited because there is no more notes receivable after you receive the cash. And we have to recognize the second part of the note interest receivable. It was recognized in 2000, was it 18? 12 months later. So yeah, on December 2018, they've recognized the first 3,000, and this is the second. Yeah, second 30,000. Second 30. I don't know how to more easily explain it so that you don't get confused. So the very first 30,000 of interest receivable was recognized in 2018. Now we have to recognize the second half, which is in 2019, also 30,000. That's why we record it here. Yeah. And finally, interest revenue of the second 30,000 we recognized here, not 60, because the first half of it, the first 30,000 of interest revenue was recognized in 2018, and that's where it stays. I hope this is very simple, and that's how this compound entry, yes, 310 on the debit side, and if you summarize this part, it's also 310. This is perfectly sensible entry, compound entry, and I hope you understand this very easily. Let's move on to a different example, or I think this is continuation. No, it's a different example. The retailer BWW does business with Seaferries, issues Seaferries a note in amount of 100,000. Yeah. So again, if you need time to read it, you need more time, just pause and read it carefully until you understand, and then join me back. So the retailer issues its customer 100,000. Again, retailer is BWW. The customer is Seaferries customer. They are so they issue a note in amount of 100,000 on January 2018. The maturity date is 6 months. Like I said, it can be less than 1 year, than a year. So the 6 months is the length of this contract, and the annual rate is 10%. On July 2, which is so. Later, yeah, so 2 days after the maturity date, the retailer determined that the customer dishonored its note and recorded the following entry. So this is how they record the dishonored. So it is very similar. This concept is similar to the bad debt, except we do not go with the bad debt sort of method because we're dealing with notes receivable. So what we're going to do is that the note receivable that we originally recorded. So let me just go back here on the top. I'll write it on the date. So when was it? January, yeah, January 2018. We recorded this, yeah, January 1, 2018. We recorded notes receivable 100,000 and sales. Was it sales? Well, this is a customer, so we will go with sales. Yeah, sales. 100,000. Yeah, was recorded here on the first date. Now, when after the date of maturity passes, we recognize that it was dishonored, and this is the entry that we make. So accounts receivable will be debited 105. Why 105? Is because the 5,000 is the interest revenue of this company. So and interest, so 100,000 multiplied by 5% and multiplied by 6 divided by 12. Yes, because this is only 6 months, and that's how we get 5,000. So we recognize both the principal, yeah, principal and interest plus interest, 105,000, and we credit notes receivable 100,000, and interest revenue 5,000 will be credited because we need to recognize the interest revenue. In fact, even though it was dishonored, we have earned that 5,000, so we record it in the credit side. This is basically us recording, or the company recording, the conversion of this notes receivable to accounts receivable because it was dishonored, yeah, as a dishonored note. What do we do later is the company, meaning the retailer, determined that the seafarers, I think it is like 2 months after the date of maturity, they have determined that that's it. This customer is uncollectible. It will not pay back its debt, and sells the balance to what they call a collection agent or debt collector. That's another name for it, debt collector company, for a total of 35,000. So they couldn't save all 105,000. Yeah, they couldn't gain all of that 105,000. Although they do. What is it? It belongs to them. In fact, it's legally it's theirs. However, they couldn't collect it, so they have managed to save at least 35 of it. They managed to save, and they sold it for 35,000. So they received cash, and they put the remaining 70,000, yeah, 105 minus 35, the remaining 70,000 they put in what we call a factoring expense. And the credit side is accounts receivable. So we basically close the accounts receivable. Yeah, we close the accounts receivable through the credit side. Sorry, I don't want you to misunderstand that this is wrong. So basically they close the 105,000 of accounts receivable through the credit, and that's how they record this sort of a notes receivable bad debt, yeah, sort of write-off. Yeah, so I hope this was understandable. So go back to this example over and over again, and again ask me questions on the comments just to be clear. And now let's move on to a different example. Alliance Cruise is a customer again of our retailer. I keep on writing it because I want you to make sure that you understand who is retailer and whose perspective we're looking at. Again, we are always looking to these journal entries from the perspective of the retailer of BWW. So the customer with an outstanding accounts receivable balance of 50,000. Sorry, the outstanding accounts receivable is of BWW. Alliance company, the customer is unable to pay in full on schedule, so it negotiates with BWW on March 1 to convert its account receivable into the notes receivable. So BWW or retailer agrees to the following terms. So 6 months note maturity date. So the length of the contract is 6 months. The maturity date is fixed. 18% of annual interest rate, and the 10,000 will be cash up front. So what we record here is that the cash up front we're going to record as a debit to our cash account. Yeah, debit to our cash account. Notes receivable will be created for 40,000. The remaining, 50 minus 10,000, 40,000. And accounts receivable will be closed because we now converted these accounts receivable into the notes receivable. Therefore, we need to close this accounts receivable account through credit. That's it. So this is as simple as it is. I hope you understand this logic and how to record notes receivable and how to treat notes receivable in the future.